Hi, people. Thank you for stopping by Building Wealth with Rajiv. Here's my chat with another anonymous investor who goes by the name Investing Bear at Twitter. His returns for last 5 years are around 1900%. Now that's unbelievable. That's insane. I talked to him about his investing style and what makes him so successful. Hope you enjoy the interview. Please subscribe to the channel and press the bell icon for such things. Hey Drew, pleasure talking to you, and thank you for giving me time. It's so fantastic to reconnect or connect, whatever you say.
Oh, it's good to talk to you, Rajiv. Thanks for having me.
Yeah. All right. Cool. Now, 2000% or what, 1900% or what, 1930% in last 3 or 4 years. That's like insane. That's like
yeah. Let's round down to 1900%.
Yeah, 1900%. Yeah.
I don't want to exaggerate, but
that's fucking insane.
Well, we've talked about this, and a lot of it was 2020. I have to say, which is I think maybe where you're going with this, because it's so interesting, right? We come into 2020, and this big scary COVID thing happens, and everybody's thinking, oh man, what do I do? Do I sell everything? Is this like a cataclysmic, it really is different this time? Because it really was different. I mean, we had not seen a global pandemic like that in, decades. And so most of us had no idea what to expect and had never been through anything like that. So it was very much the case that I was spooked. Everybody was spooked. We didn't know what to do. The thing that had been working for me for the last several years was just trying to own, I call it relentlessly pursuing the best companies, and I really do think of it as owning companies. It's not only, my investment strategy or it's not some kind of trade. It's just, I really do think of it as trying to become a part owner in these businesses. And if the businesses, and of course, at that time, it was like, well, how are these businesses even going to do if the world is going into this scary thing that nobody knows anything about? But for the most part, I held very little cash and was invested, and just said, well, I'm gonna do the best I know how. And it, as you know, and as a lot of people know, I mean, growth stocks and software stocks actually thrived in that environment, and had some of the best returns. That was the best return year that I've ever had by a lot. It was 300% gains or something in 2020. It was insane.
Mm-hmm. So I think I'll just come to the companies, Drew, you're invested in. But what did it teach you? This 2020 gains. How does it shape your investment philosophy?
Great question. It taught me that it's amazing how people think that because they know interest rates are going to go up, and maybe they know, maybe they don't, but because of that the market's going to do this or that. We didn't know what to expect in 2020, but what happened in a lot of ways was really bad. I mean, the world shut down. A lot of people died. I mean, it was a horrible year in a lot of ways. And so if you had told me that, I might have sold. If you had told me how bad COVID was going to be, I might have just sold and said, look, I'll figure this out, on the other side. But so what it taught me in retrospect is that even if you know the future, you don't know how the market's going to react to it. Mm-hmm. And it's so important to just stay humble about trying to predict anything. So I never tried to make macro predictions. And after 2020, that just reinforced that lesson to me. It's a fool's errand to try to figure out what's going to happen and then position your portfolio because of it.
And so what are you doing about the current macro thing? I mean, Fed is coming. Fed keeps this kind of a cryptic response from Fed. Sometimes saying 5 times interest rate, sometimes 6 times. Then Morgan Stanley or Goldman Sachs come now, it should be 7 times. All those idiots, I call them now, with a bit of a pinch of salt. Drew, pardon me for that. It's no arrogance here. I'm staying humble. Trust me. Uh, what are you doing with that now? Where are you with that?
I mean, obviously you hear things, but I honestly try to ignore it because I just feel like there's, take this morning, for instance. We're recording on February 10th, and this morning the inflation news came out and it was up to what, 7.5%. Again,
Yeah.
I hear all of these things usually because my friends talk about it, but I'm just like, I pretty much ignore it. And I thought, oh well, maybe it's going to be a bad day. And then mid-morning, all my stocks were going up, and the Nasdaq was up a couple percent. And then again, by the end of the day, it was back down. My portfolio did well, partly because Datadog is a large position and it had a great day, and some other SaaS stocks I think were kind of buoyed by that. Some of which I own, but the Nasdaq ended of the day down 2%. So it's just, who can predict these things? Why was it down pre-market? Why was it up, 30 minutes later? Why was it down at the end of the day? I think you can tell me what's going to happen. And this morning we got the news before the market opened, and nobody knew what the market was going to do, even at any point within the day, much less by the end of this week or the end of this month. So I really do just try to stick to finding the best companies. And, it's macro is going to affect the price of Datadog for sure. But I think what's going to affect it more is it just grew 84% or something. And, that's on
less than your portfolio though.
but that compounds, and it's at $1 billion revenue. It did 1.03 billion in 2021. So it's just, when companies are, I mean, what company grows like that? And then they guided for something like 1.5 billion next year, and that's of course going to get raised several times if they continue doing what they've been doing for a long time. So it's just, that kind of growth really does overcome a lot of things. And, I'm not particularly worried if Datadog gets cut in half because the market decides it doesn't want to price it up. I mean, who am I to say that's wrong? But I do believe from that point, I'm even more eager to own it, because now it's still going to benefit from its business just killing it, but it's also going to have room to expand again.
No, I get it. But, Drew, the one thing, you don't watch CNBC, they keep talking about up and down every day, and it becomes the headline that you don't get affected by that CNBC thing.
I try not to. I really, it doesn't cause me to act. I mean, and it's not really enjoyable either. I mean, doesn't that drive you crazy for them to say, well, here's what's going to happen, and here, this, and they have different people come on and say different things, and it's just like, well, what do you listen to? I don't know how to play that game.
Yeah. I mean, the key thing is that those people their skin is not invested in the stock market. They don't understand what's happening. They're just reading the headlines. If they invest themselves and they're seasoned investors, they probably would talk very differently.
Yeah, maybe not. There's a lot of headlines, and I defy anyone to be able to process them all. But it's nice to not have to worry about, the oil companies or the banks or whatever, and just kind of stay in my lane and do what I do best and invest in the companies that I understand.
No, I think it's more and more kind of, getting very bottom-up approach. I think the companies, I kind of agree with that bottom-up approach which you are taking, Drew. Now, tell me what holdings you have, Drew. What are your top 3 holdings?
So right now, Bill.com has worked its way up. It's had a pretty great week since it reported its earnings, and Datadog, and Monday, who reports in a couple weeks. So those are the top 3 right now. Sentinel-1 is close behind, and I have Amplitude and Zscaler are also right there. So all SaaS companies, I have two small positions, but those top 6 are, 90% of the portfolio.
It's a very concentrated portfolio, isn't it?
It is. It is. I've sort of learned over the years. I want to say back in 2017, I probably had 20 positions, and I knew much less about each of them than I know about the big six right now, because we have limited capacities to digest information.
Yeah.
And I try to follow every bit of information I can about the companies that I own, and especially follow the numbers, I think, as closely as I know how. And that takes up some time, but it also adds to my conviction in these companies.
And how do you go about researching them? You read a lot of annual reports, or I know you have a circle of some very successful investors. You have a community of very successful investors. I mean, that might be influencing you as well, Drew, isn't it?
Totally. Yeah. I mean, I think if I could give any new investor advice, having a community of people to bounce ideas off of, and to sort of track. One thing somebody's asked me, or a couple of people have asked me on Twitter, is can you do a Twitter Spaces on how you digest a company's earnings when it comes out? And so I'm going to try to do that at some point. But I think that kind of thing is just totally invaluable. Like there's no way I could have figured all this out as well if I didn't have a community of people to talk to, to talk and share information on Twitter and share information on other sites about that, how to digest information as it comes. So, a lot of it is sort of through those communities. We're all watching the same companies for the most part. I mean, there are maybe, several more than I own that are in the sort of conversation these days, but certainly that's a great way. Twitter's good, and in some ways, if you follow the right people and they're putting out the information. Message boards, the Motley Fool has some good stuff, and of course, you can just get the news the old-fashioned way, just from investor relations and stuff like that. But it sure is nice to have people to bounce ideas off of and check your math.
Yeah. No, I get it. I totally agree with you. And you find these companies. How do you find these jewels? I mean, you find them through crowdsourcing, talking to people, or you kind of run some screeners, or what do you do?
No screeners. I've tried it. Just it's really hard to make heads or tails out of what you're seeing and go through. You just kind of waste a lot of time. But yeah, I think mostly I want to have somebody. It's interesting. There have been some ideas that I feel like I've somehow glommed onto that weren't talked about quite as much, and I'm not really sure why. But there's on the message boards on the Fool, for instance. I mean, there are probably dozens of ideas thrown out. If I was just to look at the last several months, and it is pretty. I mean, that's kind of the point, I guess, of having a community, because you can sort of look at those all the IPOs that come out and just. I mean, there's not really a lot of companies in the SaaS world that we don't know about, I don't think. So it's just kind of like you try to focus in on the best ones, and I could tell you of a few that I've bought and sold in probably the last 6 months, and that's kind of the culling process of like, oh, here's Global E, or here's Confluent, and it's very interesting and it looks like it's growing really fast, and then start to add to a position, and then, oh, well, I don't like this or that, and that position eventually goes away sometimes. So it's just a continual, when I say relentlessly pursuing the best companies, that pursuit isn't always nice and clean. A lot of times you have some missed starts, and you have some that you have to be willing to part with. I think one of the best things that the communities that I sort of run in do best is selling. One of the important things is, if a company disappoints, if a company doesn't put up the numbers that you need it to, you gotta be willing to cut it.
Yeah, but which one did you cut last? Do you want to talk about it? The Globee was the Globee?
Let me answer your question accurately here. So December, actually haven't cut anything in a couple months, weirdly, because it's usually there's a couple small positions at the bottom of my portfolio that are churning. So CrowdStrike and UiPath I had back in November.
Okay.
Yeah, I think those are the last ones I cut. And UiPath never got above 2, 3, 4%. It was a small position, and it was kind of it's not purely SaaS. It's not clean SaaS, as I like to say. They've got a lot of on-prem going on, and there were just some questions about. I just really never kind of got comfortable with it. But CrowdStrike, on the other hand, was a very large position for me for a long time. I mean, going back to some point in 2019, at least, if not even further back. But it was one of the big winners of 2020, and had done so incredibly well that it was a very expensive stock at the beginning of 2021, and I think for various reasons it started to sort of stagnate, and it's funny, we had a lot of good conversations about it, because CrowdStrike is still a company growing at something like 60% year over year, which is incredible, right? I mean, it seems like so spoiled to be not happy with that. But when I was loading up on it in the beginning of 2020, it had just turned in 92% growth, and then it grew 87% through the pandemic, and it's still growing 75% coming into the year. And then in April, they do their quarters in April, July, October, January. April of 2021, they did 74%, so pretty big step down, and 70%, then 67%, and then 62%. So it's definitely slowing fast. And because it was so expensive, and this is kind of the thing about investing in the way I do, and the kinds of companies that they all get a premium. Like you're not, if you're growing at 92% or 85%, you're trading at a premium. Nobody's ignoring that. And so you either keep that premium or you don't. And so what happened to CrowdStrike in 2021 is it kind of went sideways, and ended up cutting ties with it as I saw that the growth really was slowing down. It wasn't a temporary blip or anything. And so that's why I sold. Looks like I got out in I was getting out.
But the companies can't keep growing at 90%. I mean, we talk about the Warren Buffett strategy: buy and hold, never sell. He hasn't sold Coke forever. He hasn't sold.
I think that's probably why I have a lot of admiration for Buffett, but I think that's probably why he doesn't invest in this type of company, because you just can't do that with this type of company. If you were to just buy and never sell, you would end up holding on to things that just go nowhere for years. And I think that's kind of, I think there's still hope for CrowdStrike. I think it could grow maybe even at the level of its revenue growth, if it can sort of level off here at 60%. But I don't see it getting bid up again to where, this is still a stock that's trading, if my numbers are right, it looks like it's a trailing price to sales ratio of 35. This is after it's come down a little bit. So these companies are like rocket ships. They're like, I have called them wild stallions. This is not the sort of slowly up and to the right with a couple of blips. No, these things move like crazy, and they get huge premiums. And at some point, I'm just going to flip back to a random month here. So April. In April, CrowdStrike's trailing price of sales was near 60. And I'm sure if I flip to another month, at some point it was higher than that. So, it doesn't matter how much you grow if you go down from a price to sales of 60 to a price to sales of 35, the stock's going to get hit. And that's, and you could tell me, well, aren't you worried that's going to happen to Datadog? And the answer would be, I would be if Datadog, was slowing down. But the crazy thing is Datadog is actually still accelerating, even at this scale. I mean, I will say I am, Datadog's a $61 billion company by my math. I mean, it's amazing to me that they accelerated and that they guided as well as they did, and it looks like they're going to keep growing this fast. But I do start to get concerned about, trees don't grow to the sky. So
yeah, no, I get it. So let's talk about Datadog. Now, why would you choose Datadog? Now you look at the revenue growth. I mean, what I'm hearing is that you're talking about only growth. You're talking about the top line growth. You're not talking about any other measures, Drew. You're not talking about, cash flow, EPS. You're not talking about any of that. You're just talking about, is that something which is your top criteria?
Well, you certainly want to see those things progressing, but it's funny. I think a lot of people say, well, you have this company, let's not talk about Datadog for a second. Let me just say, hypothetical company has no earnings, or it's even losing money, but it's growing at 200% or something. And then the question I would want to know is not when are they going to start showing a profit, but how long are they going to grow at 200%, right? Because you can worry about profits later. And there's a lot of caveats to this, and I would, I don't want to put it out there as if it's a perfect science. I mean, you can absolutely find a company that's, they're selling dollars for 90 cents, and they're just not going to ever make money. That happens, but that's not what SaaS companies do. SaaS companies have huge gross margins, like, gross margins in the 70s and 80s. And so they are making money on the things that they're selling. They're just spending a lot of money to grow. And Datadog actually happens to be profitable. And I think maybe that's part of the key when you get to their level, their size, because like if you have a $10 billion company, I'm less worried about profitability than I am with a $60 billion company, because it's like, okay, you are becoming a large company now. And so Datadog is definitely starting to show some of those things. But I do ask myself, going back to talking about Datadog specifically, are they worth 100 billion? Are they worth 200 billion? Will they be worth that? And so far, my answer is maybe. But the growth is kind of where it starts, right? It's like if it can grow at 84% year over year, when we're talking about a year ago, I'm going to pull up this quarter. They just turned in 326 million for this quarter. A year ago, in the December quarter, it was 178 million. That's a lot of money, when you're talking about numbers that big. And so for the year, that was over $1 billion in 2021. Like, we're talking about pretty sizable numbers and growing at 84%. I mean, who does that? And it just kind of makes me think, okay, maybe their market really is. And so, it's I don't want to just say that growth is all there is, because it's totally about more than that. But it's like, when you're talking about a number like over $1 billion for the year, they're selling to some huge companies. They're selling a lot. They actually, I noticed they led with their customers spending over $1 million a year, because usually these SaaS companies, they use 100,000 a year, because they don't have that many.
So let me ask this question: Why Datadog is the best idea besides revenue growth? Yeah, revenue growth I understand, but I'm sure there are other companies also. If they're not growing at 84, probably at 75 or 76, which is not such a significant difference. So what makes Datadog the best idea?
Well, I think I would probably be better at answering the question, why are these 6 companies that I'm in the best ideas?
Okay, let's talk about that. Yeah.
So Datadog just grew at 84% this quarter. Monday, 95% last quarter. Bill.com, 190%. Now that includes an acquisition, but I think it was like 85% organic growth. Sentinel One 128% year over year, Amplitude 73%, and Zscaler 62%, which makes it look like the laggard, but it actually accelerated quite a bit in sequential growth. So, this is if there's a so the simple, I guess, way to put it would be, these are the best companies I can find, and if you give me another company that's growing at 100%, I'm going to look at it pretty closely. but let me try to answer your question here, because Upstart, I still have a 1% or a little over 1% position in Upstart, and it grew 249% last quarter. So why is it not my largest position if it's all about growth? Well, the answer there is, I don't think Upstart's growth is the same as the growth for these other types of companies. I don't think it's as sustainable as these other, as these SaaS companies. I don't know that, I trust it to. It's not as predictable. It's not as. I think it. It may be. It could easily go from, triple digits to actually growing slower than these other companies in just a couple quarters. So, to me, that is. It kind of everything is. I want to know not just that they're growing, but that they have some staying power. And then, of course, there are the other things. Actually, when it comes to profitability, Upstart does pretty well.
Yeah.
But it's all about. So that's again. Sometime I'm going to find a better way to describe this, but profitability is not necessarily the silver bullet for me. In fact, if you can find plenty of profitable companies that are not worth investing in, because maybe they're not going to be profitable for long, or maybe they're just going to keep making less and less money every year. I'm thinking of like cyclicals and oil companies, and there are a lot of companies that are just slowly dying. I used to.
Yeah. I think the right word to use for profitability is accounting profitability. It's accounting profit. You know what I mean, because it's the way the accounting is done. And just because your accounting profit is positive doesn't mean you're a great company.
Yeah, that's a good way to look at it. When you look at the net income or the price to earnings ratio, that doesn't necessarily tell you the whole story.
Yeah. And so what I'm understanding from you is, Drew, what you do is you pick the high growth companies, ride over their growth, and when they want to slow down, you dump them.
That's probably pretty accurate. I think these companies have sort of life cycles, and this is another, again, I'm going to try to describe this someday better, but if you told me that Datadog, was trading for, let's just say a price to earnings ratio of 25, I would have a lot of questions. I don't think I would trust it. I would look at everything else and I would go, how is this possible? But that's not the way the market works. The market is predictive. And the reason Datadog is so expensive is because the market doesn't think they're done, and I tend to agree. If you sort of contrast that with CrowdStrike, I don't think CrowdStrike's done either, but I think CrowdStrike has gotten close to the level of their greatness. And I look at market caps a lot. Okay. And so when I see a company get to 50, 60 billion dollars, I start to think, what is the size of this market? How big can this really get? And Datadog is kind of the only one that I'm really willing to keep a large position in that's gotten to that size. Zscaler is pretty big. It's over 40 billion, but it's not quite as big as Datadog. And these companies have large markets, but that's the thing. It's like if you start going from 60% growth to 50% growth to 40% growth to 30% growth, it's like, well, maybe you have already been priced up to what your business is worth. And that is only proved out. The earnings only come in the future, but I don't want to keep owning the business, waiting for waiting for that to happen when I feel like the company is showing that it's kind of reached its level. And some companies obviously never make it to 50 billion or anything close. So that's not a magic number I'm throwing out. That's just it's hard. I looked a couple months ago at, we always talk about what's the next $1 trillion company, right? But let's see, there were only, when I looked, how big? 400. There were only 20 companies in the world, publicly traded companies, that were over 400 billion, or it might have even been 300 billion. But my point is, what's the next $1 trillion company? Like, who knows? But it's most you can name me 100 companies, and likely all 100 of them will never make it to $1 trillion. So let's not try to find that. Let's just try to figure out how these companies should be valued. And so, I don't want to jump around too much, but I look at something like Monday, and they're a $10 billion company, and sure, they've got a fraction of the revenue that Datadog has. Their profitability metrics aren't as good. But they're growing even faster. And it looks like they're trending in the right direction. So if you wait until Monday is profitable and has
you missed
earnings
the boat.
and they're had as much revenue as Datadog, that's going to be the time to sell. Maybe.
Okay. All right.
Does that make sense?
No, makes sense. Look, there's no right or wrong answer, Drew, in investing. It's one thing you think, and then what works with the personality. Like, for example, you're sitting on an extremely high beta portfolio, isn't it?
For sure.
Yeah, and
I agree with you that this style is not for everybody, and it's something that I'm still honing for sure. I'm not. I don't know that I would have described it in the exact same way a year ago. I'm still trying to figure out exactly what it is I'm doing, and I think you very perceptibly picked up on. It really is, Joe Stock Novice talks about, it's riding an S curve. You're trying to buy it at the point where the inflection is just kicking off and hold it for the rapid growth. And the thing is, once it gets to the top of that S and starts leveling out, that's kind of what I'm trying to say is when the company is kind of fully valued for, maybe for the long term, or at least, getting up close to that. There are certainly different types of investing, but with these types of companies, that's just kind of the way it goes, because there's so much of the future gets priced in, right? Because they're growing so fast, and their business models are so attractive. And so it's like, well, how do we price this? There's really not a good answer. And so those things get baked in. And again, I'll steal another phrase from Stock Novices, is they either keep their premium or they don't. Like, so Datadog is not cheap. Price to sales is 59 trailing. So that's, what is that forward? It's 30 something forward. That's expensive. But if they're growing at 84% or even 80%, they're going to keep that. Now, if they drop down to 70% and then keep dropping each quarter, they're not going to keep that. And maybe when I say keep that, maybe the market decides to stop paying up for SaaS stocks, and then Datadog and everything else drops from 59 to 39 or something. But the point, but I can't control that, and I don't even try to. I just know that wherever it stops, that's the point where it starts growing again. And I've been through that, and it's no fun. But I don't see a way to avoid that.
No, but look, I think as I said, it's a lot about investing style. Do you regret missing stuff like Tesla? For example, Tesla never grew that much, right? 90%, 95%. I don't remember. Maybe I'm wrong, but 2011, 2010, whenever it got listed, never grew that much. But if you look at 10 years history, it's probably one of the most successful stocks in the history of stock market, or 60%. What I'm saying is that if you see the returns from 2011 to 2020, about 50% annualized. That's huge. So they did not grow that much, but they're still a very successful stock, isn't it?
Yeah, No, I mean, to answer your question, no, I don't regret missing out on really anything. I mean, I'm pretty happy with my 1900% in the last 5 years, so I'm not complaining. I think Tesla, it looks like, I'm just looking at the chart, it looks like it might be up about that much, about the same as my portfolio in the last 5 years. And so, I'm happy for Tesla shareholders. That's definitely a stock and a company that I don't understand at all. And I could say that about a lot of companies. I've never owned Netflix. I've never, there's a lot of things that have done really well, and I just, didn't get it. And that's totally fine with me. Kind of like, when SaaS stocks get sold off, that's totally fine with me, because quite frankly, there's nothing I can do about it. I mean, I could try to get out at the perfect time and get back in, or hedge somehow at the perfect time and hope I don't lose on the hedge more than I'm making on the hedge. And I could try to do a lot of things, but what I think, developed a competency for is buying great companies. And so I kind of try to stick to that.
Yeah. Now, I think one thing, I have three more questions, Drew, before I leave you. One question is, I just want to go back to 2020 success. Is which was the top gainer for you in 2020? Which stock contributed mostly to 1900%? Was it all holdings? Was it one holding or two holding which contributed to a disproportionate increase?
Yeah, great question. I don't actually track it like that, but I can give you some numbers. Of the stocks that I held in December, at the end of the year still, let's see. CrowdStrike was up 325% that year. And of course, that's from January 1 to December 31. So if you bought on any dips, you might have made even more than that on CrowdStrike. Cloudflare was up 345% for the year, from January 1 to December 31. DocuSign was up 200%. Zoom was up 396%. Etsy was up 301%. So, I mean, there were a lot of, I don't know which one I made the most on. It might have been CrowdStrike, because it was my largest at a lot of times. But I mean, I remember buying Cloudflare, let's see, it ended the year at $76. I mean, I think I was buying in the 30s and 40s. CrowdStrike's a better example. It ended at $212, which is more than it's at now, I believe. Back in January, it ended January at, well, I guess it was up in January, but it started the year at 49, and I think in that January of 2020 it probably got down to 30 something. So again, you could have made even more than 325% on CrowdStrike in 2020.
But the Drew, one thing which I noticed, you talked about 5 stocks, right, which contributed most to your gains. None of them is in your portfolio now. You have no love, no affection, no attachment to your stocks. Is that true?
That's right. I'm very mercenary with these companies. I mean, the thing is, I've thought about this many times, and it's funny enough, you're not going to believe this, but this is something I learned from Buffett, Warren Buffett.
Yeah.
the buy and hold forever guy. But he has said many times that Mr. Market, is always out there. He's always offering you irrational prices, and sometimes you got to take it. So let's say I had, instead of 5 stocks, let's say I had 5 lemonade stands, in 5 different, parts of the city, right? And they were all making, I don't know, what does the lemonade stand make? $10,000 a year. So, maybe these businesses are worth $100,000 to me each, right? So I've got 5 $100,000 lemonade stands. And somebody comes and they offer me, $1 million for just one of them. Well, of course I'm going to take that. I mean, that's an irrational price. And what I'm going to do is I'm going to reinvest that money into the other stands, or buy 10 new stands, or, that's kind of how I see both adding and trimming to my current positions when things get, in my opinion, out of whack, or moving from one position to another. It's not that I don't think CrowdStrike is a good company doing good things for the world. It's just that I don't have to own them at any particular time. They'll be just fine without my shekels, and I can put them into another business that I also feel that way about.
Yeah, I think, look, I'm learning a new thing every day, and that's the beauty of investing, Drew. And yeah, come on.
Oh, I just said amen to that. That's I don't know if you've seen my Twitter profile, but it says I'm wrong about a million things, but yesterday it was 1,000,001. So that's exactly how I feel. If I can just get a little bit better every day, that is part of the fun. So amen.
Yeah, I think, look, I'm putting that in perspective now. I saw that title of yours on Twitter, and I was a little amused by that. As I was amused by your name, Bear. But I think that humbleness in you is probably one of the reasons for your success, I guess, because had you put your tweet other way, you probably returns wouldn't be that high, because right now you're kind of letting market do its trick, and you're not thinking that you're smarter than market, because had you been thinking that, probably your returns would have been that great. And I think that's look at stock novice, right? The man has done so well, but he calls himself novice, right?
I think you're right. I think you do get rewarded for humility.
Yeah.
I had a Twitter Spaces with some friends a couple weeks ago, and one of the things I wanted to drive home was like, look, we've all made serious mistakes. I mean, we owned a company called Lightspeed last year, and it did not do well. I mean, we made a little bit of money and got out. Most of us got out fast enough, but it was not a good call. We expected something that didn't happen, and that happened to me with a quarter that Upstart threw up last year, and I expected something, and it didn't even come close to happening. And so, I think the point is, if you're humble, you can just say, well, I messed up, or I didn't know the future, and so be it, but we can make a lot of mistakes in this business and still do incredibly well. It's kind of amazing.
Yeah, no, I think too, I'm a little surprised, Drew. Your kind of holdings are very much same as a lot of other great investors like Stock Novice, Gawker Richer, Soul, but you're not carrying Snowflake. What's preventing you from carrying Snowflake? All of them carry Snowflake,
Good question. They've all asked me that, actually.
Okay.
And I maybe I'm wrong. This kind of goes back to the humility thing. I'm not saying that they're missing something, but for me, Snowflake is it's over 100 billion by my math.
Yeah, it is.
And I think if they can keep growing at 110% or something like that, they're going to do just fine. I question what's going to happen if they drop to 80% growth even. It's kind of the same as the CrowdStrike thing, right? 80% growth, that sounds amazing. But when you're priced like Snowflake, I'm not necessarily sure that is. And when I look at the numbers, what I think I see a little bit differently than those other guys who are friends of mine and are great investors, what I see differently is I see that slowdown coming. And that may be a mistake. I may be wrong about that. I may be reading the tea leaves the wrong way. But I tend to sort of stick to my process, even if I'm, unless someone can show me what I'm missing.
Yeah. No, I think the vulnerability in Snowflake is much higher than what it is for, let's say, Bill.com or Monday.com, because they're small size. But I think the moat in Snowflake is very high. That is, and I kind of see that you haven't talked much about moat, economic moat, or Monday.com is not a business with. It may have competitive advantage, but it's not like a business with very differentiated product or something. Look, I don't know. I'm not an expert on Monday.com. All I'm trying to say is Snowflake has certain kind of moat, which many other businesses might not have.
Yeah, I think that's a great point, and I think moat is hugely important, and that's the reason that Datadog is still growing at 84%. Again, I've just been marveling all day. I've been like, they're over $1 billion a year now, and they're still growing like that.
It's monster.
But but that's what it is. It's moat, right? There's no other
Yeah.
reason that their customers would be paying them that much money, other than that they're offering something very valuable and they're doing it better than anybody else. You could say that's not the case with Monday because we don't know yet. That's why Monday's a $10 billion company instead of a $60 billion company, and that's why, even though they're growing at 95%, so somebody likes them, we don't know what's going to happen when they get, from 260 million in revenue to 500 million. And then, maybe they're going to be growing at 50% at that point, and then the company will probably not be that much more valuable than it is now, because that kind of a slowdown makes you lose your premium. Now, kind of interestingly, Monday's not really getting a premium, but we don't have to like hash all that out. But that's those are the dynamics, and you're 100% right. If Snowflake has the staying power to grow for years and years and years, they're going to do just fine. It's just I kind of look at the long term and the short term, and quite frankly, I'm better at looking at the short term because it's really hard. I'm not a techie. I don't really know these products that well. I just know what their customers, are doing.
Yeah.
And so I don't really know, does Snowflake blow right through, they're already over $1 billion a year, which is great. Do they just blow right through 2 billion and they're still growing at 100%? I just don't know the answer to that.
Yeah, no, I get it. And I completely understand, Drew, where you're coming from. And, I've read somewhere that most money in stocks is made when the companies move from competitive advantage to moat, because once they develop a moat, after that, as you said, it's about expectation, right? The company has a competitive advantage, the market expects it to develop into a moat, and they start paying for it, and then the price keeps going up. Look, I mean, this is just some observations of what I'm reading, not right or wrong.
For sure, yeah. No, I believe all of that, and I understand, to some limited level, I understand all of that, but I think it's really hard to predict. I think it's a lot easier to sort of look from quarter to quarter and say, look what this company is doing. It looks like it's likely to continue in the short term, and maybe that is proving that it's got some staying power for the long term. But that latter part is, I stick in a maybe, put in I'm not so sure, is Datadog going to become a $100 billion company, a $200 billion company? I don't know. I mean, I just know that right now it looks like it's going to keep, killing it for a while, and I want to be involved until I see that change.
Yeah, I mean, it's funny, and it's very, again, it's a lot about art. Your thinking is very long term in certain sense, that is, you're looking for great businesses, but it's short term in the sense that you're looking quarter to quarter. You know what I mean? When you're focusing,
it's definitely both. I mean, and again, I think I'm better at the short term than the long. Like, I think the long term is really hard, and that's why I have a problem with value investing, is because it's all long term, and if you're wrong just a little bit, it throws off everything.
Last question. Now, I generally used to ask this question, like, how do you value stock? Now, I think I'm kind of losing a lot of faith in that, again, through valuing stock. I mean, can you even value something like this? Let me ask this question. How do you decide on the pricing? How do you decide, okay, I'm okay with this price? I'm not talking about valuation here at all. It's too complex.
Yeah. I mean, I have debated this with myself for years. I've held on to vestiges of value, investing. Not that I ever was a good value investor or anything, but like, that's kind of what you learn first, and I've got a finance degree, so I thought that I understood some of that. I think to answer your question directly, I would just say it's pretty much relative analysis, comparative analysis. Like if Sentinel-1, for instance, was, half the price of Zscaler, and yet it's growing, half the price to sales ratio, or whatever ratio you want to look at, and yet it's growing, at 128%, Zscaler is growing at like half of that. that wouldn't make sense to me. That's not the case. I'm just saying if that were the case, then that would lead me to probably add more to Sentinel-1, and maybe even take it from Zscaler. No, this is not necessarily that simple. I have companies that are growing at different rates. But if something, let's say a company comes along and it's growing at 45% year over year, well, all of my companies are doing better than that. So I'm probably not going to be too interested in that company. Well, if you tell me I can get this company for a price to sales ratio of 10, then I'm like, well, that's interesting, but what's it going to do next? I mean, maybe the market's saying that it's about to slow down even more. And that might actually be the case right now with DocuSign. I haven't looked at the actual numbers, but that's kind of what I was thinking about when I was describing that. So, it's certainly not a perfect science, but it is kind of just a comparison of hey, I've got these companies that are doing about this. Their prices kind of make sense. Monday is at a lower price to sales ratio because we're not quite as sure about its staying power. Datadog gets a premium because it's been doing it for so long. All these kinds of things, but it's basically just comparative. I don't have a sense of, like, if you were to tell me that the price to sales of Datadog should be, 69 trailing instead of 59 trailing, I would be like, well, maybe. It seems expensive to me.
I get it.
That's as far as it goes for me.
I think, look, Drew, I can talk to you all day. I'm really enjoying it, but thank you so much. I think you may have things to do, and I think there is another guy knocking at my door. Just talk to that guy. But let me just tell you a little bit about humility. That when I talked to you first time, I thought you probably would have returns about 190% over 5 years, not 1900%. So you came out of it 10 times more than what I thought about you. It says a lot about your humility, and I wish you continued success and hope you give me time again in future.
I like to set expectations low so I can beat estimates. But no, I appreciate the kind words, and I humility does mean a lot to me, and I do think it really helps. So I appreciate that, and I've really enjoyed talking to you, Rajiv. I'd do it again anytime.